Imagine it's 16 October 2019. You are a 48-year-old bank employee living in Beirut, Lebanon. You help manage a furnished apartment building, and 13 tenants send rent through a city that still believes its banks are built on stone. Your savings sit in dollar accounts at a local bank, earning the kind of interest that feels almost generous. The Lebanese pound has been fixed at 1,500 to the dollar for so long that the number feels like gravity. In the evenings, you drive past glass towers, bright cafes, and shop windows full of imported goods, and it all looks normal enough to trust. You think the money in your account is money, not a promise, not a rumor, money. If you have ever wondered why some people seem to come through financial disasters with their lives still standing while others watch decades of work dissolve in weeks, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before, and it always leaves the same clues behind. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the floor shifts. The next day, protests erupt over a planned tax on WhatsApp calls, banks close their doors, and the crowd outside grows thick with people who want the same thing you do: access to their own money. Weeks turn into months. Your dollar deposits are no longer really dollars. They are numbers trapped behind glass. By 2020, as Beirut is shattered by the port explosion, you're repairing your building while struggling to find the hard currency suppliers demand. In a Reuters report, Joe Nader, the man in this story, says his family has begun selling possessions for cash, including gold, prayer beads, and paintings. That is how quickly normal life can become salvage work. This is what this video is about. Not how to predict the exact date of a collapse, not how to get rich from disaster, but what history shows about the kinds of assets that tend to hold up before a financial system breaks, why they hold up, and why the things that look safest on paper often fail first. Because collapse is rarely one giant explosion. It is more like a bridge rotting from the inside. From the road above, everything looks solid. Then one morning, the weight is simply too much. Before we go further, there is something important to understand. In almost every collapse, the real problem is not just falling prices or rising prices or one bad politician or one bad bank. The real problem is that people confuse assets with claims. A house you own outright is an asset. Gold in your hand is an asset. Foreign cash in a safe is an asset. But a bank deposit, however safe it feels, is also a claim. It is your legal right to ask a bank for money back. A pension is a claim. A bond is a claim. Even local currency itself is a kind of social promise. It works because everyone agrees it works. When a country borrows too much or pegs its currency too rigidly or fills its banks with bad loans and government debt, the promises begin stacking on top of each other like chairs in a dark room. For a while, no one notices. Then one chair cracks, and suddenly the whole pile comes down at once. People think they own wealth, but what they really own is permission. Permission to withdraw, permission to convert, permission to spend at yesterday's price. When the state is desperate and banks are weak, permission disappears. That is the secret key to the whole story. Before a collapse, the best assets are usually not the ones with the most impressive statement value. They are the ones least dependent on a local promise being honored tomorrow morning. They are pieces of reality in a world made of paperwork. They are lifeboats, not decorations on the ship. This brings us directly to the first part of the pattern. When a currency itself begins to fail, the assets that survive are usually the ones priced by the wider world, not by the dying unit at home. Look at Germany in 1923. After the First World War, the Weimar Republic was under crushing strain. The state faced war debts, reparations, political unrest, and then the French and Belgian occupation of the Ruhr in January 1923, which wrecked production in a critical industrial region. The government kept paying workers and funding resistance, but it did so by creating more and more paper marks. That is the core mechanism in its simplest form. Too many units of money, too little trust, too few real goods. At first, the damage felt abstract. Then it became physical. Prices rose so fast that money started melting like ice dropped on a stove. By November 1923, one US dollar was worth 4,100 to 10,500,000 dollar marks. A loaf of bread in Berlin that had cost about 160 marks at the end of 1922 cost around 200 billion marks by late 1923. Workers were often paid and sent straight to the shops before the notes in their pockets lost more value by evening. Families bartered. Cigarettes became a medium of exchange. Coins and goods were hoarded because paper money was turning into printed panic. And this is where the asset question becomes brutally clear. If you were a careful cash saver, the kind of person who did everything the old world told you to do, you were destroyed. Middle-class households that had saved in marks saw years of discipline vanish. Pensioners were wiped out. Salaries lagged behind prices. Insurance policies became jokes told by history. But if you held gold, foreign currency, land, shares in firms with real assets, or inventory that people still needed, You were living in a different universe, not a painless one, but a different one. This was not because gold had magical powers. It was because gold was not a promise from the German state. A foreign currency note was not a promise from the German state. Coal was not a promise. Wheat was not a promise. A farm was not a promise. They were things, and when paper burns, things remain. There was another twist, one that still surprises people. Hyperinflation did not hurt everyone equally on the debt side. Those who owed fixed debts in collapsing currency could sometimes repay with money that had become almost worthless. In plain English, the burden of yesterday's debt shrank while the burden of today's prices exploded. That meant some debtors with real assets underneath them could survive, or even emerge stronger, while savers without hard assets were hollowed out. The fire did not spread evenly through the house. It raced through paper walls first. What did ordinary people actually live through? They lived through the destruction of time. That sounds abstract, so let me make it simple. Savings are stored time. Work done today, kept for tomorrow. In Weimar Germany, tomorrow kept disappearing. You could not plan because value would not sit still. The future became a moving target, and when the future breaks, people grab anything solid. That is why hard assets, foreign money, and useful goods suddenly mattered more than bank balances. The market was screaming a message in plain sight. Store value in things the printing press cannot create. Now here is where it gets interesting. The same logic appears again and again, even when the crisis looks completely different on the surface. Here is something I want you to think about before we go further. If your savings are in a bank, in what sense do you really own them when the system that holds them becomes the problem itself? Drop your answer in the comments. Seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. Argentina, in 2001, did not look like Weimar Germany. This was not wheelbarrows of banknotes. This was a modern banking system, a middle-income country, and a public that believed it had found stability through the peso's one-to-one peg with the US dollar. 1 peso was $1 by law. For years, that peg made everyday life feel predictable. But it also made the economy rigid, like a man trying to run in a suit of armor. Exports became uncompetitive. Debt piled up. Recession dragged on. And behind the scenes, people started to understand a terrifying fact. There were not enough dollars in the system to satisfy all the claims marked as dollars. That detail matters more than almost anything else in this video. Many Argentines thought they had dollars. What many of them really had were dollar-denominated claims inside a banking system sitting on weakening foundations. When enough depositors tried to leave at once, the truth was exposed. On 1st December 2001, Economy Minister Domingo Cavallo imposed the Corralito, capping cash withdrawals at 250 pesos or dollars a week. Electronic payments still worked, at least in theory. But Argentina was a cash-heavy society. For millions of people, especially in the informal economy, cash was oxygen. And suddenly the oxygen was rationed. Journalist Karina Echegaray later recalled that she and her family were in the process of buying a flat in Buenos Aires when the decree hit. The money for their new life was frozen in the bank. By the time Axis returned, after devaluation and inflation had done their work, she said it was enough to buy a car, not a home. That is the difference between nominal value and real value. The number may survive. The life it was meant to buy does not. Argentina then spiraled. Riots broke out. Banks were attacked. Supermarkets were looted. President Fernando de la Rua resigned on 20th of December. The country defaulted on about $85 billion of sovereign debt. The peso, long chained to the dollar, snapped loose and fell from 1 to more than 3 per dollar in a matter of weeks. According to Brookings, GDP per capita fell by around 20% during the crisis period, unemployment climbed to 25%, and poverty reached 55% of the population. Those are not statistics. They are millions of private disasters. And yet, even here, the pattern of relative survival is visible. Businesswoman Michaela Restano told the BBC that she had a small amount saved in US dollars when the meltdown began. In the chaos, with hard currency suddenly scarce, she exchanged those dollars at a very favorable rate and used roughly $6,000 to pay off her mortgage. Same country, same collapse, completely different outcome. Why? Because her asset was not trapped behind the same door. This is also why rural land, export businesses, and assets tied to world prices recovered faster after devaluation than urban cash savings trapped in the banking system. Once the peso fell, exporters earning foreign currency were no longer breathing through a straw. A weaker local currency hurt wage earners and savers, but it could help those tied to external demand. Argentina's later recovery had many causes, including a better external environment and strong soybean prices. But from the household level, the lesson was simpler. A claim inside a vulnerable bank is not the same as a hard currency note in your possession, and neither is the same as productive land or business selling goods the world still wants. The vault door, in other words, was never really steel. It was stage scenery. It looked solid until people leaned on it. This leads to the second part of this story. Sometimes the currency does not die first. Sometimes the banking system breaks before the money does, and the asset that fails is not cash in general, but bank money in particular. Look at Cyprus in 2013. This was a euro country. That matters because many people assume collapse only happens in weak currencies. Cyprus showed something colder. Even if the currency itself survives, your deposits can still be used as shock absorbers for a failing banking system. The roots ran back to bad bank balance sheets and heavy exposure to Greek debt. Cypriot banks had chased yield, which means extra return, by buying risky assets that looked profitable until they were not. When losses on Greek bonds punched holes through those banks, the island could not rescue them alone. So Cyprus became a testing ground for something Europe had not done on this scale before. A bail-in. That sounds technical. In plain English, it means the people inside the bank, including large depositors, are forced to absorb losses. Reuters profiled Andrew Georgiou, a 56-year-old depositor whose family had moved from London to Cyprus in 2012 for a new start. He and his father brought their savings with them. And when his father heard rumors that Laiki Bank was in trouble, Reuters reported that a bank manager persuaded him not to move the money, saying the institution was effectively state-backed. 2 weeks later, Laiki went under. The Georgiou family had 750,000 euros there. Some was covered by deposit insurance, but much of it was trapped in confusion, legal fights, and permanent loss. The wider numbers were severe. Reuters reported that about 4.3 billion euros in deposits belonging to 14,000 entities were affected by the winding down of Laiki. Savers were left with at most 100,000 euros, the ceiling on deposit insurance under European rules. At Bank of Cyprus, deposits above 100,000 euros took a 47.5% haircut, which means nearly half was converted into bank equity to recapitalize the lender. Think about what that means in human terms. One day, you believe you hold liquid savings. The next day, a large chunk has been transformed into shares in a broken bank you never wanted to own. And this is where history gets uncomfortable. Deposit insurance can protect some people, but insurance lines are political lines. They tell you where one promise ends and another begins. Above that line, your bank balance is not sacred. It is part of the capital structure. That is a dry phrase for a brutal reality. In a crisis, you may discover that your savings were sitting much lower in the safety hierarchy than you imagined. Cyprus teaches a different lesson from Weimar and Argentina, but it points in the same direction. Direct ownership mattered, diversification across institutions mattered, geography mattered, the legal structure of the asset mattered. People with money spread across safer jurisdictions or kept below guaranteed limits or owned real assets outside the banking chain were not immune to fear, but they were less exposed to a single bureaucratic decision. Once again, the survivors were not always the people with the highest balances. They were the people with the fewest invisible dependencies. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you're still here, you're not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. The same mechanism, different countries, different decades, same result. In Weimar Germany, the local currency failed and cash savers were erased. In Argentina, bank deposits and the currency regime both cracked, and people learned that a dollar claim was not always the same as a dollar. In Cyprus, even inside the euro, deposits above an official threshold were turned into rescue material for the banking system. On the surface, these look like separate stories. Hyperinflation, devaluation, bail-in. But beneath the surface, they are versions of the same old drama. Too many claims, too little trustworthy backing. When confidence breaks, the system starts ranking assets by reality. First come direct claims on scarce things, then strong external money, then productive assets with cash flow. Last come local paper promises with multiple layers of counterparty risk, which is a complicated phrase for a simple danger. Too many other people have to stay solvent, cooperative, and calm for your wealth to remain yours. A bank deposit in normal times feels like water in a glass. In a crisis, it turns out to be water in a pipeline owned by other people, controlled by valves you cannot touch. A pension feels like deferred salary. In a crisis, it becomes a budget item. A local bond feels safe because the state stands behind it. In a crisis, the state is often the problem standing behind the problem. So what assets tend to hold up before collapse? History keeps pointing to the same families of protection. Hard money outside the local system, precious metals, foreign currency in direct custody, productive land, useful inventory, ownership stakes in businesses tied to real demand, especially if their revenues are linked to world prices or foreign earnings. And, just as important, low leverage, because debt is a rope around the ankle when the bridge gives way. At this point, the pattern becomes impossible to ignore. The best assets before collapse are usually the ones with the least dependence on trust in the collapsing structure itself. There is also a counterintuitive fact hiding inside all of this. In crises, people often repeat the phrase, cash is king. History says that sentence is only half true. Cash can be king only if it is the right cash, and if you can actually reach it. German marks in 1923 were not king. Dollar claims inside Argentine banks in 2001 were not king. Large euro deposits inside a failing Cypriot bank in 2013 were not king. Even dollars inside Lebanese banks stopped behaving like dollars once withdrawals were forced through inferior exchange rates. The real question is never just, do you have cash? The real question is, whose liability is that cash, in what jurisdiction, under what rules, and how quickly can those rules change when panic arrives? That is why people who have already lived through one collapse often behave in ways outsiders find paranoid. Reuters reported in 2019 that after Argentina's primary election shock, dollar deposits in the banking system fell by $1.9 billion in a single week, about 6% of the $30.5 billion total. Argentines who remembered the Corralito preferred to stash savings at home or in safe deposit boxes because memory had taught them a hard lesson. After enough historical repetition, distrust stops looking irrational. It starts looking like scar tissue. And yet the story is not complete until we talk about who pays. When systems crack, the first people hit are rarely the best connected. They are the middle-class saver, the pensioner, the wage earner, the small shop owner, the landlord with tenants but no liquidity, the family that did everything by the book. History does not spread pain like rain. It falls more like acid. It burns paper claims, fixed incomes, and cash balances first. Look at Greece in 2015. This was not Weimar-style inflation. It was liquidity failure, which means money existed on paper, but access to it narrowed sharply. On 29 June 2015, Greece imposed capital controls and shut its banks. ATMs were limited to 60 euros a day. Reuters reported that as banks remained closed, the government ordered 1,000 branches to open specially for pensioners, allowing a maximum payout of 120 euros for those without cards. In Athens, Reuters interviewed Konstantinos Nikolopoulos, a 70-year-old former employee of Warner Brothers, who emerged from his bank empty-handed after being told his pension fund had not sent the money. He was told to come back tomorrow. That single sentence contains the whole cruelty of a banking freeze. Come back tomorrow. Collapse often arrives as a delay. The shutdown lasted 3 weeks. Reuters reported Greek businesses lost about 3 billion euros during the closures. Again, notice the hierarchy. People with digital access, foreign relationships, or cash reserves were inconvenienced. People dependent on local branches and monthly flows were humiliated. When banks close, time itself becomes expensive. Deliveries stop. Rent deadlines still arrive. Medicine still costs money. The economy turns into a machine running without oil. Now, return to Lebanon. In 2020, Reuters described Nadim Sroor, a 43-year-old who had returned from the Gulf with his wife and 2 sons only a month before the banking system imploded in late 2019. His savings were frozen. He could withdraw at a bank rate of 3,900 Lebanese pounds to the dollar, while the street rate had touched 8,000. In other words, even when he got access, he did not really get access. He was allowed out through a side door into a worse exchange rate. Reuters also reported Lebanon's unemployment rate had risen above 35%. His father Maurice, who had rebuilt savings once before after an earlier currency crisis, could take out only the equivalent of $1,000 a month. Retiree Samir Sfer could withdraw only $700 a month. Joe Nader, the man from our opening, said his family were selling gold, prayer beads, and paintings for cash. This is the human cost of a banking collapse. People do not just lose money, they lose sequencing. The order of life breaks. Repairs must happen before a roof collapses. Medicine must be bought before an infection spreads. School fees come due on schedule. Suppliers want payment today, but the bank tells you to wait. Collapse turns adults back into petitioners. And then there is Zimbabwe. Estimates suggest annual inflation peaked in November 2008 at 89.7 sextillion%, one of the worst episodes ever recorded. Reuters later wrote that memories of the 2008 blow-ups centered on inflation that wiped out pensions, savings, and confidence in the currency before Zimbabwe abandoned it in 2009. In such moments, the difference between owning money and owning something money can still buy becomes everything. Households with access to US dollars or South African rand, with cattle, with tradable goods, with relatives abroad sending hard currency, were not comfortable. But they were not standing empty-handed on the same trapdoor. So who comes through relatively intact? Usually not the person with the prettiest account statement. Usually the person with hard currency income, real assets, low debt, some liquidity outside the banking chain, and something useful to sell no matter what the local balance sheet says. The historical record shows that those who came through these periods largely shared three characteristics. First, they owned things that did not depend entirely on the local currency. In Weimar, that meant gold, foreign exchange, land or businesses with real inventory. In Zimbabwe, it meant access to foreign notes, livestock, or goods that could still be traded. In Argentina, it meant cash dollars, export exposure, or property that could reprice after devaluation. Second, they reduced dependence on a single gatekeeper. The people who were most exposed in Cyprus and Lebanon were often not reckless speculators. Many were simply concentrated. One bank, one jurisdiction, one official conversion rate, one narrow channel between their savings and the real world. When that channel broke, their wealth became a hostage. Those who had diversified institutions, kept some assets outside the local banking web, or held assets in direct custody had more room to move. Optionality, which means the freedom to choose between paths, was itself a form of wealth. Third, they were not buried in fixed obligations that had to be serviced on perfect schedule. This is where debt matters. Debt can be useful in normal times. But before a collapse, heavy debt is like trying to outrun a flood while carrying furniture. The historical record again and again shows that low leverage increased survival because it bought time. Time to wait, time to reprice, time to avoid forced sales. Notice what is missing from this list. There's nothing here about genius stock picking. Nothing here about predicting the exact month of a crash. Nothing here about a secret formula known only to hedge funds. The pattern is humbler than that. Survivors tended to hold assets that could still function when the local system malfunctioned. They understood that return on paper and resilience in real life are not the same thing. A 2% extra yield means nothing if the principal, which means the main amount you thought you owned, becomes inaccessible. This is why seemingly dull assets can become stars during breakdowns. A small farm with water access, a shop with necessary inventory, a paid-off home in a place people still want to live, a business earning some revenue abroad. Even practical tools and trade skills matter more than people expect. Because collapses do not just reprice money, they reprice competence. When the formal machine jams, people who can repair, transport, grow, or source essential goods suddenly sit much closer to the center of value. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. Now, this is not the same as saying there is one magic asset. History does not give us a holy object. It gives us a checklist of properties. The assets that hold up best before collapse tend to be scarce, directly owned, globally recognized, useful, and hard for a desperate state or bank to redefine overnight. Gold fits some of those traits. So does strong foreign cash. So does productive land without crushing debt. So do shares in real businesses with pricing power, export income, or ownership of things people must keep buying. Even simple inventory can matter. In inflationary breakdowns, a hardware shop with nails, fuel, soap, or spare parts may hold more real value than a savings account that cannot buy breakfast next week. And there is one more counterintuitive fact most people miss. The winner in these periods is often not the bold risk taker. It is the boring person who preserved flexibility, the person who did not chase every extra point of interest from a shaky bank, the person who understood that yield, which means return, can be bait. Lebanon offered remarkable deposit rates for dollars before the crash. That should have been read like bright paint on thin ice. High returns from a weak system are often not gifts. They're distress signals in costume. So if you want the deepest historical answer to the title of this video, it is this. Before a collapse, the best assets are usually the ones closest to reality and farthest from the promise structure that is beginning to fail, which brings us back to Beirut and back to Joe Nader. He did not cause Lebanon's debt binge. He did not design its financial engineering. He did not choose the peg, the politics, or the balance sheet tricks that turned deposits into trapped numbers. He simply lived inside the system until the system turned and showed him what it was made of. By 2020, he was fixing damaged apartments for his tenants while selling family possessions to raise dollars because suppliers no longer trusted the same money that once seemed safe in the bank. That is the final lesson. In good times, the most dangerous assets are often the ones that look effortless. A high-yield deposit in a weak banking system, a pension promise from an overburdened state, large cash balances in a currency held up by politics more than production. They feel calm because the storm has not reached the shore yet. They sit there like glass ornaments on a shelf, pretty right up until the shaking starts. They reward complacency in the sunshine and then demand faith in the storm. But history shows that when the tide goes out, people do not scramble for complexity. They scramble for direct ownership, hard currency, useful things, and freedom of movement. You do not need to be a doomsday preacher to understand this. You only need to read the record honestly. High public debt, artificial exchange rate pegs, banks stuffed with government paper, Sudden offers of unusually generous returns, long periods of stability resting on short-term funding. These are not guarantees of collapse, but they are echoes. And history's echoes matter because they tell you where to look before the wall cracks. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it, but if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.